Top three things this morning in my notebook. Number one, the U.S. dollar. Number two, Japan. And number three, Europe. So we're going to cover all the three big bases. First on the U.S. dollar. Number one, you had Janet Yellen devalue the dollar yesterday, which is, of course, dovish, which is, of course, what she is, a raging dove, which was good for commodity price inflation. It goods for a little bit more stock price inflation. But now you get what you get. And at the end of the day, that's not a good thing, which is GDP growth slowing. So again, look, GDP growth slows from 4.1% to 2.4% as the deflator rises. The deflator rises. In other words, as inflation accelerates, GDP slows. Bingo. Japan does not like this. That's point number two, because, of course, as the dollar goes down, the yen goes up. As the yen goes up, the Nikkei goes down. So if you're long the Nikkei, you're having a very, very bad year, down 9% for the year to date, as the yen actually is one of the world's best performing currencies for the year to date, because it'd be really tough to be worse than the Federal Reserve, which, of course, took their balance sheet last night up to $4.16 trillion. $4.16 trillion. That's up, if you're keeping track, $1.1 trillion year over year, like we need that. And in other news, Europe, finally, point number three, the Europeans are actually getting their banks to pay back the LTRO. Their currency is hitting a new high this morning. We're along of that in euro terms. So again, we like the European currency. We like the British currency. We don't like the U.S. currency. So again, in the face of inflation accelerating here in the U.S., we want you to pivot and be long both European currencies and countries from an equity perspective. We have not changed our mind on that. And yes, being long European equities has been a better place than U.S. equities for the year to date. So those are your top three things.